right, welcome back, everybody, for the last segment of today's show. This is Kyle Bazzi filling in for Joel Elconin. Again, I'm going to keep saying it because I'm jealous. He's sitting on a beach somewhere in Jamaica, so I hope he's getting a tan at least. Up next, we have Matthew Porzio, VP of Strategy and Product and Marketing for Intralinks. Matt, good morning.
Good morning, Kyle. How you doing?
Good, good. I was just saying, long time no see. Got the pleasure of interviewing you and learning more about what Intralinks is doing. Can you give everybody else a brief introduction for your company?
Sure. Intralinks is a leader in business collaboration software. More specifically, and I think more relative to your listening audience, is going to be the virtual data room technology that we've pioneered, which helps people essentially execute M&A transactions online and share information in that due diligence process. And as such, we have this unique view into thousands and thousands of global deals each quarter that look to use our technology to accelerate that due diligence process.
All right, so this is very interesting to me and something I love bringing on here to the pre-market show. Talking about other tools and insights for us to look at the markets with. Who are your clients? Obviously, mostly institutional. Then companies, PE firms, looking for those M&A deals.
Yeah, it's the large and even mid-market investment banks. It's the corporates that are highly active acquirers, but also divesting assets. It's the private equity world, which is integral to deal flow as well. So it really runs the gambit of everyone, all the professionals within the M&A community.
All right, so what I love to talk about is what kind of insights can we get? This has obviously been a big year for M&A. I feel like every single Monday this year, we've just had some major announcements from the weekend. Have you guys seen activity through increasing this year?
Yeah, absolutely. I mean, one of the things that our deal flow predictor enables us to do, right? Deals that we're aware of or that we see are usually, using our technology 6 months before they'll be publicly announced. So as early as June of this year, we were predicting, somewhere between 6 and 11% growth for the full year of 2014 announced deals. And if you look at the actual data through Q3, it's still a little too early to tell for Q4. But, the Thomson data would show that, the number of deals globally is up over 7%. And as we predicted with our Q2 deal flow predictor, which really is the data for Q4 of this year, Q4 is going to be strong in terms of announced activity, continuing that trend. And we believe, year over year, 2014 will see a 10% plus increase. So a really strong year for M&A.
All right. Now, I read a blog on your website, intralinks.com, the Deal Closer blog, as it is called, the art of getting closer to closing deals. And the blog title was The Right M&A Strategy to Outperform the Market and Your Peers, published on December 1st. What is that strategy, and what have you seen on your guys' platform that we could get some insights into the market? Hot sectors, how to look at M&A deals, things of that sort.
Yeah, I mean, it's interesting. We did a study in conjunction with the Cass Business School as part of City University of London that looked at, what makes a successful M&A strategy, right? And there's been a lot of reports out there over the years by, pretty respectable firms that say, M&A deals fail to create shareholder value, run from M&A. And those studies were pretty much, very condensed, looked at a very small sample, looked at 1 or 2 deals that an acquirer might have done. We took a much longer period of time, 20 years, and looked at over 25,000 firms that engaged in M&A over that period of time. And we looked and we saw those companies with an active M&A strategy doing more deals than their peers, doing more acquisitions on average, outperformed their peers in the market and their competitors. They also needed to do some divestiture activity as they matured as companies, kind of pruning of their, portfolio or their assets. So that strategy of active buying, more active than your competitors, but also being willing to divest non-core assets, is a trend that outperforms the market. So if you find investment opportunities where that company profile is in place, you're going to do pretty well for yourself.
All right, let's talk about some hot sectors. Even last year into this year, was there a transition, and what has this year told us where these M&A deals have been?
Yeah, in terms of deal flow this year, the major sectors, from 2013 to 2014 in terms of our deal flow predictor have kind of remained, right? Energy has been pretty hot, manufacturing, financial institutions, even life sciences and professional services. Through this year, we've seen kind of a similar trend. What I'd add to that is we saw pretty good growth in consumer products in terms of the number of deals. And again, energy, manufacturing were strong. The biggest change that we saw probably last quarter was high growth in telecom, media, and entertainment, as well as technology. So as we head into 2015, you're going to see more deals announced in the telecom and media sector, as well as in the technology sector. They were pretty strong. The market overall was pretty strong, but those are the ones that you're going to see the most immediate pop in terms of announced deals in 2015.
All right, so high growth in telecom, entertainment, and media, and then obviously technology, and you're seeing that continued growth in 2015. That's great. And in terms of, I'm going to ask you a question for the people that are listening to this show and in the chat room. We're market participants. We're not institutional. We're more retail. Is there any insights from the data you guys have, or even content you publish, for how we can look at that? So I'm looking now in the technology and telecom sector. What kind of companies are we looking for that are prime for these types of takeovers, for maybe growth in bigger companies or something like that?
Yeah, again, because what we're measuring is not the typical sort of value, overall market value of deals, which can be swung by really large acquisitions of public companies happening. What we're reporting on is actually the number of deals. So again, from an investing standpoint, the increased activity, say, in telecom or technology means there's a lot of mid-market deals being done, right? So if you're invested, in a broad range of mid-market tech companies that you feel have, say, a unique intellectual property angle that a bigger acquirer would be interested in, there's a good chance that you're going to see deal activity and an acquisition premium on those companies in the future, right? That's when we talk about tech deals increasing in value, increasing in activity. We're not talking about, just the mega deals that everybody reads about. We're talking about more the large acquirers buying smaller assets. So if you can find those, smaller, unique public tech companies, mid-market on down, there's a good chance that you're going to see some acquisition activity there.
All right, now it's been rumored for a while and just announced as official recently, PetSmart to be acquired by BC Partners Group, the largest LBO of the year. Is this any indicator for the market here with what could be happening? Obviously, PetSmart, another consumer type product there. Anything like that you seeing?
Yeah, I mean, I mentioned consumer products as one of the industries that year over year we saw, a significant increase in terms of deal flow. I would say that private equity has been extremely active in that sector, picking off really on a global basis, picking off what they would look at as, premier or unique consumer product brands. And I think that's what you're seeing with the PetSmart LBO. And in general, LBO activity has been up really in all sectors. I mean, even, the activity we saw in the energy sector this year of former, energy, executives getting private equity backed money, taking out smaller asset groups and building essentially a platform. I think you're going to see more of that. I mean, there's a ton of private equity dry powder out there that has to be put to work. And if you've got, some unique brands in consumer products, or you've got, an energy, a platform where people can build on, those are two areas that I would think you're going to continue to see the growth.
All right, let's jump over to that Talisman TLM, obviously with the news today up 46%, up to $7.50. Are you seeing, and obviously we just had the open here, Talisman Energy, obviously oil and gas producers. We had Hurt Capital in the chat room actually asked too, and these are related. Are you surprised that there hasn't been more merger activity in the gold and silver miners, considering the price declines? TLM is the same thing with oil down, catastrophically. What are you guys seeing in that sector, commodities and metals, and do you see more activity with the depressed prices?
Yeah, I mean, it all depends, right? I mean, there's a theory that obviously the depressed pricing in any commodity causes some people to recognize, hey, I can't go it alone. It's time to sell or at least divest non-core assets. And I think you'll see some of that, as I mentioned, like in the energy space, in the shale areas, some of those non-core assets, those non-drillable assets, we're already starting to see, come to market, because of the declining oil prices. I think, there's always a balancing out effect. So you'll have some distressed activity or some kind of forced activity, especially if these assets have been leveraged up and they got to make interest payments, which may also increase over time. But what I think you're going to see is a pretty steady amount of activity. The deals that have already been in play, the recent declines in like oil prices, not going to have a huge effect on those, might tweak the valuations a bit. I think what you're going to see going forward, and I think that's why the mining industry didn't see the level of activity they thought, is that everybody is affected by this. And you'll have some of these major acquirers even pull back and be a little concerned about overextending themselves in M&A, even though valuations are really good. So it's almost that balancing effect. It makes, targets more, palatable for acquirers, but acquirers are dealing with their own issues internally as commodity prices drop.
Again, everybody, we're here with Matt Porzio, VP of Strategy and Product Marketing for Intralinks, having some great insights into the M&A activity. So obviously with the depressed prices, then you're pretty much saying that all the companies are hurting. So it's not as if there are the bigger ones that are doing better. I mentioned earlier in the show, I saw some analysis ran on oil itself and saying, if we say it's $60 a barrel, here's the companies with the cost structure that could survive that $60 level. Obviously we're down even lower to that. Looking at the futures on oil right now, sweet crude oil, it's 54, staying right around that level. If those companies can hold and we continue at these levels and don't improve, those smaller companies are obviously hurting and need to restructure their costs. Will those bigger companies be able to raise money if needed, improve their capital structure, increase their cost structure, and then start to acquire those companies?
Yeah, I think that's what you'll see over time, right? There might be initial trepidation of, buying some of these, not quite distressed, but certainly in need of restructuring asset pools out there. But over time, I think, as those larger companies feel a little more confident and stable, and their boards and shareholders are on board in terms of, snatching up some undervalued assets, knowing that, the price of oil at some point they hope will come back. That's a pretty good strategy. And as I mentioned earlier, the study that we had commissioned and done shows that, right? That if you're willing to take that chance and you can get your company and your shareholders on board with snatching up undervalued assets before your competitors and more often than your competitors, you're going to outperform the market. But that's sometimes a tough call when you're seeing the commodity price continue to drop.
All right, crude futures right around 54.18. Let's take a look at the ES here 5 minutes after the open. Right at about 1976.25. All right, Matt, what are your thoughts on some of the most prominent M&A deals that were made in 2014? Obviously, we're wrapping into the holidays here in the end of the year. What were some highlights for you?
Yeah, I mean, listen, what I'm always thinking about, and I think this is, really interesting probably to your listeners, is that, the deals that steal the headlines and, things like tax inversion deals and all these, deals that were even scuttled post, those grab the headlines, but that's not really what's driving the market. And that's why when we talk about deal flow, we're looking at, the number of deals done. And, when we're looking at a 10% year-over-year increase in announced deals, when 2014 is all buttoned up, that's impressive, right? That really speaks to the overall, really the fruition of all these elements that have come together of, stronger economic growth, capital availability, right, the interest rate environment. It finally happened. And, that's a level of growth that we didn't see until, really coming out of the global financial crisis in terms of the number of deals. And that to me is a much better calling card in terms of the health of the M&A market than some of those marquee deals that are announced. It's great to have, $30 billion deals done, the things like, the combination of Kinder Morgan, back to our energy sector conversation, that's great. But in terms of the overall market, the real interesting thing is, the smaller mid-market deals that were just firing on all cylinders this year.
Why do you think that is? I mean, obviously, with companies like Intralinks coming up, is it easier for those mid-level deals who might not have the infrastructure? When a $30 billion deal is done, money's really not an issue when you're talking about spending on lawyers and different people, structuring the actual deal itself. Is that why we're seeing more mid-level deals, or what are your thoughts on that?
Yeah, I mean, absolutely. I think, right, the factor of globalization in the M&A market now, a mid-market company in the Midwest of the U.S. isn't just looking regionally, to sell itself to its, top three competitors. It can leverage platforms like Intralinks to reach globally, right? And advisors are much more advanced, right? I mean, even small mid-market advisors, instead of having to build offices all around the world, leverage platforms like our Deal Nexus platform to market deals to buyers in China or buyers in Brazil. So there is sort of a technology concept of shrinking the globe and making deals more accessible. It's also, there's less fear of the process dragging out too long and being a detractor of value. A lot of people, when I was a banker, didn't want to partake in M&A, didn't want to really test their market value because that could be a pretty big distraction in terms of the process. Now the process has been pretty streamlined and accelerated where smaller targets say, let's give it a whirl. And if it doesn't work, we can always pull our deal back and, it's not a huge loss for us. So there's definitely efficiency in the deal market that wasn't there, even 10 years ago.
And I'm dropping a link into the chat for everybody, and it's on Intralinks' website, and it's the Intralinks Deal Flow Predictor, our quarterly prediction of future trends in the global M&A market for Q1 2015. On the right, you can download that PDF. Matt Porzio of Intralinks, VP of Product there and Marketing. Thanks so much for coming on, Matt. Some great insights on M&A, and looking forward to another hot year for it in 2015.
Same here. Thanks, Kyle.
All right.